Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, May 31, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And it was an interesting day across the markets today. We started out where there were several markets relatively weak across the board, namely the financials, the energy sector, and also the transportation average, which we'll get to those later. But the S&P, while it did take a dip, as did the IWM, which we'll also get to, they did recover, and the S&P, or the SPDR, as you can see, is basically finishing flat for the day after taking a dip, and all it really did was fill this gap, and it came up a few pennies short of my desired level, but it filled the gap for all intents and purposes early this morning, and then basically grinded higher the rest of the trading day. So as you can see, we're essentially putting in another bullish consolidation pattern, setting up for higher prices yet coming. So we can obviously dip a little lower. We can come back in to retest the 40 level. If the market wants to, it will be obviously supported. Maybe it's not obvious, but it would be supported by the upsloping 20-period moving average that comes in right below the important $240.08 level. It's a gap fill level from before, and what was once resistance becomes support, especially since you have the 20-period moving average sloping up in that direction slightly below that level, now coming in at 239.61. So the market would find support at slightly lower levels anyway, and also continue to eat some time off the clock, building some energy for the next move higher. The longer it goes sideways and pulls back a little bit, coils back up, builds some energy, the more strength it will have on the next move higher. So it's okay if we eat some more time across or along the clock, or off the clock, I should say. And that appears to be what's happening. But underneath the covers, underneath the hood of the market, we have to look at some of the other sectors of the internals. So I like to look at the financials, and specifically, you look at the top, let's say, 4 financials, and also represented, and the charts look very similar, by the XLF. And what you can see here is that the XLF has had more downward pressure, and certainly the chart looks different. We're nowhere near the all-time highs, so different than the SPY. And that was one of the things that I had been pointing out recently. We're below the moving averages, the 50 and the 20, and there's still some overhead resistance here. And what we're finding is, while the SPDR is eating time off the clock and trading near the upper range, you have some sector rotation going on, and you can also see it in the XLE, which is the Financial Select SPDR. Here you can see how this index, and obviously the underlying stocks within it, have been under pressure lately below all the moving averages, and this daily chart is just ugly, sloping downward. When you go to the larger time frame, what do you see on the weekly chart? You see us potentially coming into a support level, which is essentially a retracement of pivot low to pivot high. It's around a 50% retracement. I think this line is an old line, and it may need to be adjusted. It may be here for a different reason. I don't quite remember. However, it looks to be a 50% retracement from a pivot low to pivot high. So if we're going to get another market rally, and we did see sufficient sector rotation in seeing a sell-off in the energy sector, seeing the financials weak, are they going to get ready to rally? Here's a bearish pattern on the weekly chart in the financials. Where is the bottom? Are we just going to banter back and forth and now go higher yet again to the upper end of this range? Or is this bearish pattern going to play out to the downside, and are we going to see some sector rotation back into the financials as the market rallies? That's a question that needs to be answered relatively soon. When you go back to the daily chart, and I think this is worth looking at because the financials are definitely a market leader. And when you look at JP Morgan, this is not a sign of strength. So something is going on underneath the covers in the financial markets, and rates are lower. The bond market's been rallying. That's a negative for the financials. But why aren't they at least staying on par with the market, maybe down slightly when factoring in interest rates decreasing? When interest rates go down, it puts downward pressure on bank earnings because they make their earnings in part on the spread of what they borrow at and then in turn what they lend money at. And when that spread narrows, meaning rates are going down, that spread is narrowing, that puts pressure on bank earnings or forecasted earnings. And that's part of what's going on, but there's more to the story in this chart that it's nowhere near the same look as the spiders, and it's one of the most important charts on the board in terms of the S&P and certainly the financial sector. When you look at Goldman Sachs is also in trouble and had what is not necessarily the worst close in the world today. We don't need this line. That was old. Staying above 210 was important, but not a great close. Closing below the 200 period moving average. Technically speaking, this zigzag pattern is probably complete from pivot high to pivot low, and high here and a low here. So that's symmetrically complete, but that doesn't mean there's no downside in the cards for Goldman Sachs. There could be more for certain. And when you look at this chart, you can just see in advance that this weekly chart does not look great, and it looks like it wants to move into the 50-week moving average down here at 204. That's what this chart looks like. That's where it's headed. Whether or not we get a reversal before that happens, we'll see. But definite weakness for Goldman Sachs. How about Wells Fargo? And sorry, I'm spending a lot of time on the banks, but I think it's important to realize, does this want to come to gap window just below $49 a share, or is this done on the downside? We rallied to close above this pivot low, right? So the pivot low is 51.26. Pardon me. The pivot low is 51.26, and we closed at 51.14. Sorry about that. So we did close below that pivot low. So that's an important development. I didn't see that till just now. So that's also important on this chart in particular. That could mean more downside coming. That's certainly where the odds are leaning today with this particular close. It's always how they close them, not necessarily how they trade them. When you look at Bank of America also looks weak on the chart. It looks very similar to all the rest. Headed lower. This pattern, technically from a symmetrical standpoint, could be deemed complete. We had a nice bounce off the lows today. However, not out of the woods yet. Need to see some kind of a reversal. There was high volume today, which we'll have to see what happens tomorrow. If we see follow through to the upside, there may be something in the cards for the financials. 147 million shares today against a 91 million average, 90-day average volume. And when you go back and check the other ones, Goldman Sachs had a nice volume day, more than double the volume. JPM. This could be potentially an exhaustion day for the financials. And I'm just thinking this through and unpacking this as I discuss it with you guys. I just didn't see the volume on these financials until just now. I didn't look at it ahead of time. My fault. I should have. However, I just didn't notice it. So I'm liking what I'm seeing here in terms of volume. If we see any kind of upside activity early tomorrow, that could be a sign of a temporary bottom and help the market levitate to new highs. Let's see the XLF. Yep, good volume in the XLF as well. And you see the XLF, unlike the stocks, did not take out the lows here, which is a temporary positive sign for the XLF. Did not take out the recent lows where some of the larger financial stocks did. All right, you got the point in the financials. The transports came off their lows nicely, just making a bullish pattern. You see how we went all the way down. They were deep in negative territory earlier in the day, and they rallied all the way back to close pretty much on the flat line, continuing to make a bullish pattern, building energy for higher prices. The next major area of resistance on the upside would be this double top area here that comes in at roughly 9,300. On the downside, this bullish pattern still stays intact as long as we maintain a daily close above 90.39.41. Now, moving over to the gold market, gold had an uptick today, and we continue to slide higher. This is a creep higher, a grind higher. It's a slide higher. We're above all the moving averages. That's positive. Now we're in the August contract. I think we rolled this on Thursday or Friday of last week into the August contract. And this gap fill area, while higher than it was before, comes in at 1286.60 area. That's where I believe gold wants to go to fill this gap up here. Just may take a few days to get there, but that's where I see it heading. We're on the creep higher. We did see somewhat of a divergence in the silver market, a divergence to gold. Silver had a little bit of a pullback while gold was up. So there was a divergence, silver being down 0.7%. And each and every day, they do not trade in tandem. We know that. On the bigger scale, over the bigger picture in time, they do trade in tandem or have a tendency to do so. So I'm not going to read anything into today's activity. I think we're just into a decent level of resistance, being the 50-period moving average up at 17.5, at decent overhead resistance up there. It's a nice retracement area, and it's overhead resistance, and therefore it's just a pullback, nothing more, nothing less in silver today. Crude oil, on the other hand, got smashed down a little bit, and we talked about the fact that these large days generally mean more downside is coming. When they happen from, these important levels, this was a good retracement area. We talked about getting, and this is the forward contract. Oh no, this one hasn't rolled yet, but we talked about retracing up over the $50 level. That was a 50% retracement from pivot high to pivot low. That happened. We fell off again. This proved out that at least more times than not, when you see a large down move like this, it generally puts in a bearish pattern and moves lower. This bearish pattern didn't play out for more than a couple of days. I would have thought it would take a little bit longer, but it's still working its way lower, and I don't think we're finished yet on the downside. At least this chart is not necessarily telling me that. We had decent volume today, but not reversal or exhaustion type volume, so we're going to get into that 47, maybe even 46 zone before this retracement is done. That's what I think. I think they're going to come in for a nice healthy retest down in this area, and that may provide a trade to the upside, but it's not there yet. Needs more time. We'll obviously discuss it each and every night. Going over to the bond market. Bond market is also doing everything we've talked about out of this bullish pattern. It's creeping higher. We had a nice healthy up day on yesterday on Tuesday, and then today we saw some follow through. Bonds don't move that much in one day, but as you can see off this low, for certain they've been one heck of a move on the upside, and now we're approaching this double top area, and I think we can get up to 154.20 area on this move. So again, here we are with the bond prices creeping higher, yields creeping lower. We have the potential for a Fed interest rate hike, or at least an announcement, in the month of June. So that's going to play into bond market activity. The bond market's trading higher as the overall broader stock market index isn't budging. We've had the financials struggling of late, yet put in a high volume day today, potentially an exhaustion day. We'll see if these markets are going to start reverting back to what we'll call the mean, but they have to revert back to some sense of normalcy. There's been too many divergences, and one market will ultimately have to catch up with another, and I think we're about to see which one's which, pardon me, over the coming trading day or two. And with that, I'm going to give it a wrap there. Oh, no, I got one more. Pardon me. We have the dollar. And so the dollar we find resting right around our important level of 96.97. So we saw a downtick. It could be this bearish pattern playing out. We're not seeing real strength yet showing in the dollar. It looks like it wants to come down and touch the lower portion of this trend channel that we've been watching for quite some time. So let's see what happens over the next day or so in the dollar. The bigger picture is not going to change. Whether it touches the lower portion of the trend channel or not, we should be in the zone for a blast off to the upside in short order and sooner than later. So with that, I'm going to wrap it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.